If your house is paid off, the IRS and your state government may already be treating that equity like a piggy bank with your name on it, and they're just waiting for you to die to crack it open. That sounds dramatic. It isn't. In 2026, a combination of Medicaid estate recovery rules, capital gains exposure, and property tax miscalculations is quietly draining the retirement security of millions of homeowners over 65 who thought owning their home free and clear was the smart play. And the cruelest part? The people getting hit hardest worked the hardest. They paid off their mortgages. They did everything right. And now a system of overlapping rules almost nobody explains clearly, is set up to collect from them anyway. Let me show you exactly how this works, and then let me show you the exits. Here's the scenario I want you to hold in your mind. Margaret is 71. She lives in a home in suburban Indiana. She's owned since 1979. She paid $42,000 for it. It's worth $310,000 today. She has no mortgage. Her husband passed 3 years ago. She's on Medicare, draws Social Security, and has about $58,000 in a savings account. She feels secure. She feels like she made all the right moves. 2 years from now, Margaret has a stroke. She needs nursing home care. Within 18 months, Medicaid has placed a lien on her house for $127,000 in care costs. When she dies, the state takes that money before a single dollar reaches her kids. That lien didn't appear out of nowhere. It was always there, lurking in the law, invisible until it wasn't. And Margaret's paid-off home, the asset she was most proud of, became the thing the government collected from. This is the 2026 dead equity trap. Let's break it down layer by layer. Start with what dead equity actually means. Financial planners use the term to describe home equity that isn't working for you. Money sitting in your walls that generates no income, provides no liquidity, and can't be easily accessed without selling or borrowing. For retirees on fixed incomes, a paid-off home often represents the single largest asset on their personal balance sheet. For many families, it's 60, 70, even 80% of their net worth. But here's the problem that most people don't see until it's too late. Equity sitting in a home doesn't just sit quietly. It attracts attention. Medicaid sees it. The IRS tracks it. Property tax assessors reset it. And each of those systems has rules that can chip away at what you think you're passing down to your children. Let's take Medicaid first, because this is where the largest and most misunderstood exposure lives. Federal law, specifically the Omnibus Budget Reconciliation Act of 1993, requires every state to operate a Medicaid estate recovery program. What this means in plain English is that if you receive Medicaid benefits after age 55, your state is legally required to seek repayment from your estate when you die. And for most seniors, the estate is the house. In 2026, nursing home care costs an average of $9,733 per month in the United States. Memory care units run higher, $6,935 to $12,000 per month depending on the state. Long-term care is the largest unplanned expense in retirement, and most people don't have long-term care insurance. So they burn through their savings, qualify for Medicaid, and Medicaid pays the bills. What they don't realize is that Medicaid is keeping a running tab. The lien gets placed on your property, often while you're still alive and receiving care. Some states place it immediately when Medicaid enrollment begins. Others wait until death. But either way, before that house can transfer to your children or grandchildren, the state steps in and collects its share. Here's a real number to put around this. The average nursing home stay before death is 2.3 years. At $9,733 per month, that's roughly $268,000 in total care costs. If Medicaid covered most of that, your estate owes most of that. For Margaret in Indiana, with a $310,000 home and $127,000 in accumulated Medicaid claims, the math is ugly but simple. The state takes $127,000 off the top. Her kids split the remaining equity, minus probate costs, minus property taxes owed at death, minus any other liens. A $310,000 asset just became something closer to $150,000 divided among however many heirs she has. Now layer on the capital gains issue, because this is the second trap, and it catches people who never go near Medicaid at all. When you sell a home you've owned for decades, you owe capital gains taxes on the profit above your cost basis. Your cost basis is roughly what you paid for the property, plus the cost of major improvements. If Margaret paid $42,000 in 1979 and put another $30,000 into improvements over the years, her basis is around $72,000. Her home is worth $310,000. That's $238,000 in gain. The IRS gives married couples a $500,000 capital gains exclusion on a primary residence. Single filers, which Margaret is because her husband passed, get $250,000. So Margaret is sitting on $238,000 in gain. She barely clears the exclusion. If she made any additional improvements she didn't document, or if the house has appreciated further by the time she sells, she could owe federal capital gains tax on the excess. In 2026, long-term capital gains rates for a single filer run from 0% to 20%, depending on income. But here's the part that shocks most retirees. When you add capital gain income to your Social Security and your required minimum distributions from any IRA, your total income can spike you into a higher bracket than you've seen in years. A capital gain that pushes your income above $47,025 kicks you into the 15% rate. Above $518,900 and you're at 20%. Most retirees aren't near those top numbers, but the gain from a long appreciated home can absolutely push someone from the 0% zone into the 15% zone, costing them tens of thousands of dollars they didn't see coming. And then there's the Medicare premium trap. This one is specific and painful. Medicare premiums are income tested under what's called IRMA-A, the income-related monthly adjustment amount. If your income crosses certain thresholds in a given year, your Part B and Part D premiums increase, sometimes dramatically. In 2026, the standard Part B premium is around $185 per month. But if your income exceeds $106,000 as a single filer, that premium can jump to $259 per month or higher, and the surcharges stack up from there, reaching over $590 per month for the highest earners. Selling a paid-off home in the wrong year can spike your income enough to trigger IRMA-A for the following 2 years. 2 years of elevated Medicare premiums on top of capital gains taxes. That's a compounding hit from a single transaction that most people never model out in advance. Now let's talk about what you can actually do about it. Because there are real, legal, documented strategies that protect home equity from each of these traps. The key is timing and structure. The first strategy is the Irrevocable Medicaid Asset Protection Trust, or MAPT. This is the most powerful tool available for protecting a home from Medicaid estate recovery, and almost nobody knows about it. Here's how it works. You transfer your home into an irrevocable trust. You can still live there. You still pay property taxes. The home just no longer counts as your personal asset for Medicaid purposes after a 5-year look-back period. That 5-year window is critical. Medicaid will review any asset transfers going back 5 years from the date you apply. If you transferred the house within that window, they treat it as if you still own it. But if the transfer happened more than 5 years before you apply for Medicaid, the house is protected. Consider what happened with Donald and Ruth, a couple from Central Ohio. Donald was 68, Ruth was 66. Their home was worth $290,000. Their financial advisor recommended a MAPT in 2019. Donald had a serious health event in 2025 and needed memory care. Because the trust had been in place for over 5 years, the home was fully protected from Medicaid recovery. Their 2 adult children inherited the full equity. Without that trust, the state would have had a valid claim against most of it. The cost of setting up a MAPT typically runs between $2,500 and $5,000 in attorney fees depending on your state. That's a small price to protect $200,000 or $300,000 in equity. The second strategy is the life estate deed. Simpler than a trust, useful in some situations, not perfect. With a life estate deed, you retitle your home to your children now, but you retain the right to live there for the rest of your life. At your death, ownership passes automatically to the remainder men, the people named in the deed, without going through probate. It also counts as a completed gift for Medicaid purposes, which starts the 5-year clock. Barbara, a 70-year-old widow from Florida, used a life estate deed to transfer her $265,000 home to her son in 2021. She retained the right to live there. In 2026, she applied for Medicaid assistance. The 5-year period had not yet elapsed. She was just shy of 5 years, so Medicaid did apply a penalty period. But because she'd gotten close to the 5-year mark, the penalty window was short, and her son helped cover care costs during that gap. The lesson is clear. The earlier you act, the cleaner the protection. Life estate deeds are not quite as flexible as MAPTs. They're harder to undo if circumstances change, but they're cheaper and faster to set up. The third strategy addresses the capital gains trap specifically. It's called the stepped-up basis at death, and it's one of the most valuable tax provisions available to retirees who don't need to sell the house while they're alive. When you die and your heirs inherit your home, the IRS resets the cost basis to the fair market value at the date of your death, not what you paid for it in 1979, what it's worth on the day you pass. That means if Margaret dies with her home worth $310,000, her children inherit a home with a $310,000 basis. If they sell it the next month for $310,000, they owe zero capital gains tax. This is the plant from the opening coming back around. The dead equity trap is real, but only if you or your estate tries to liquidate the home under the wrong conditions, at the wrong time, without the right structure. The equity is not automatically dead. It can be protected, transferred, or inherited in ways that sidestep every trap I've described. The stepped-up basis rule makes holding the home until death a genuinely powerful strategy for people who don't need the cash. Combined with a Medicaid trust that keeps the home out of the estate recovery system, you create a structure where the house passes to your heirs with a clean title, a reset basis, and no government lien. One more thing that doesn't get enough attention: property tax exemptions. In 2026, most states offer significant property tax relief to homeowners over 65. Homestead exemptions, senior freeze programs, circuit breaker credits. But these programs require you to apply. They don't apply automatically, and in many counties, the deadline to file is early in the year, February or March, which means retirees who don't know about the deadline miss it entirely and pay hundreds or thousands in unnecessary property taxes. If you haven't confirmed your current exemption status with your county assessor's office, do that this week. Seriously. A quick phone call can save you $800 to $2,000 a year, and in some states, you can claim credits retroactively for the past 2 or 3 years if you miss the filing. Here's where this all lands. A paid-off home is a tremendous achievement. It represents decades of discipline, sacrifice, and commitment. But the financial and legal system in 2026 does not reward that achievement automatically. It rewards people who understand the rules and structure their affairs accordingly. The dead equity trap isn't one thing. It's 3 things hitting from 3 directions at once: Medicaid recovery, capital gains exposure, and Medicare premium spikes, all triggered by the same asset: a home with a lot of value and an owner who hasn't planned for what comes next. The fixes are real: Medicaid asset protection trusts, life estate deeds, holding for the stepped-up basis, property tax exemption applications. None of these require you to be wealthy. They require you to act before the crisis hits, not after. Margaret didn't have to lose $127,000. With a trust set up even 5 years before her stroke, the whole picture changes. Her kids inherit the full equity. The state gets nothing from the house. Everything she worked for stays in the family. That's what proper planning actually looks like. Not complicated, not expensive, just done. If you've got a paid-off home and you haven't talked to an elder law attorney about a Medicaid protection trust, I want you to drop a comment below and tell me what state you're in. I read these, and I want to know what part of this hits closest to home for you, whether it's the Medicaid piece, the capital gains exposure, or something about the property tax side of this. Your question might end up shaping the next video. If this video helped you see something you didn't see before, share it with someone you know who owns their home free and clear and hasn't thought about any of this. It could save them a 6-figure mistake. And if you're not subscribed yet, hit that button, because next week we're getting into the Social Security taxation trap that's quietly hitting more seniors every single year as interest rates stay elevated. You're not going to want to miss that one.